the recording? Okay. So in case of institutional investor, we understood that the institutional investors are in general will be they are the representative of uh, some individuals. Some individuals may include the current generation, but in addition to the current generation, some individuals can also be the future generations. On behalf of these individuals, institutional investors work. So institutional investor, by their scale and by their presence, you can easily understand that obviously their scale will be greater and their sophistication will be much more stronger or much more intense compared to the average private client. So we like to stress 2 points which uh, will be essential to understand the IPS of the institutional investor. First of all, uh, governance framework of the institutional investor. We mentioned the point that there will be a strict governance system or governance procedure in case of institutional investor, which is unlikely to be present in case of individual or private client. So when strict governance is there, in that case, there will be more transparency, there will be more accountability, there will be more discipline in investment and the relationship between wealth manager and the client. But that is to be likely to be underestimated in case of private client relationship, but it is much important in case of dealing with the institutional client. So in case of governance structure of institutional investor, if you think of let's say if you think of uh, Harvard University endowment, okay, let's think of institutional investor, Harvard University endowment. So there will be a board of director for that endowment. Specifically for board Harvard endowment, university endowment, there will be separate board of directors in the typical governance structure. So the question is, who will be the part of this board of directors? So the institution, let's say the university treasurer, university president will be part of this board of directors, or their representatives will be there. It is one component that is coming from the institution, which is the sponsor or which is a core part of this endowment fund. And another representative can also be here from the alumni. So there will be university alumni. Representatives from the alumni group will also be there in board of directors. This board of directors is of which? It is board of directors of endowment fund. Okay. Then there will also be representatives from the student. You are familiar with the student union. So from student union, there will also be a representative in the board of directors of this endowment fund. So this board of directors will make very specific strategic decisions for this endowment fund for the well-being of the university. So you have got a structure that who will oversee this endowment fund. Okay. So there will be kind of this board of directors will also be present in case of foundation. Okay. For example, if you think of the Prime Bank Foundation, okay, you are probably familiar with this one if you are recipient of a scholarship. So in prime bank foundation, you will also see there will be a board of directors who are representing different stakeholders of this foundation. Okay. So in addition to the directors from the institution, from the alumni, from the student here in case of endowment, board of directors is also likely to include independent director. So typically when independent director is there, we are prone to think that independent director will ensure more transparency, more accountability, more governance there. But in addition to those purposes, what we know typically, another purpose of independent director in case of board of directors of institutional investor is not to ensure those, not only ensuring those things what I just have mentioned, but also to ensure that board of directors has a good amount of technical skills to understand the investment, to understand the well-being of this institutional investment, and to examine and to evaluate the investment made by the investment committee. So other than the purposes of typical purpose of independent director, another purpose to include the independent director in case of board of directors of institutional investor, another purpose is not is to enhance the investment expertise of the overall board. So you may expect that a president of the university in case of endowment fund, or the treasurer who is likely to be included or appointed from the university academia, and alumni representative and student representative, you may expect that they will be the part of board of directors, but they may not have the required amount of investment expertise needed to make sure that board of directors understand that the how the endowment fund is going well, or to evaluate the investment made by this endowment fund. And there will be a separate committee. In addition to the board of directors, there will be a separate committee which is known as investment committee. So what we are learning right now, we are learning how governance structure of institutional and investor look like. So we are giving example of endowment fund here or a foundation here. You can replicate this structure for other institutional and investor, and how their governance will look like. There will be investment committee. Okay, so that is separate from the board of directors, but the representative from board of directors may be present here in investment committee. So investment committee, by the name, you can understand what will be the task of this investment committee is to make investment based on the investment objective set by the board of directors. Okay, investment objective is to be set by the board of directors, but actual implementation of the investment and overseeing the investment are and monitoring, rebalancing, then making sure that risks are within tolerate level. These things are the task of investment committee. Okay, so you probably have uh, learned about this position, chief investment officer. Other than chief financial officer or chief executive officer, uh, it has become very familiar nowadays for you to come to know about this term, chief investment officer. So who is the typical leader of the investment committee of institutional investor? Okay, so he leads the investment activities of the institutional investor, but it's not the whole task of the CIO to oversee the investment of the institutional investor. Rather, he will be supported by some support staff. He will be supported by some support staff. And you may ask, what will be the expertise level required for this support staff? Will they have the same level of expertise like CIO? But the thing is not like that. Usually, supportive staff has expertise in individual asset class. For example, there is a supportive staff, Mr. A. He has a expertise in fixed income asset class. Or there is a B. He has an expertise in equity asset class. But there is a varying nature of classifying the asset class across the institutional investor. It may be like that Mr. A has expertise in US equity. They have defined an asset class that Mr. A task is to have expertise in US equities, and Mr. B will have task to have expertise in global equities. So based on this classification, there will be some supportive staff who will support the chief investment officer to execute the investment plan and the asset allocation set by the investment committee. Okay. So investment committee is usually has a reporting responsibility to the board of directors, and board of directors itself is representing or has accountability to all the stakeholders, to all the stakeholders. So if I ask you who are the stakeholders of an university endowment fund, okay, so you can easily give me the answer that alumni will be the stakeholder, the university administration will be the stakeholder, current student will be the stakeholder, future student will be the stakeholder of this university endowment fund. Okay, so uh, usually it is expected that, just to give an example regarding the how a stakeholder may create conflict. Okay, that is kind of some students or current students may think that why endowment is giving only 5% amount out of their asset under management every year, they could give 25% so that required amount of expenses required by students from their own family will go down. So students, current students will always ask for more flow, more inflow from which fund? From the endowment fund. So what will be the benefit if more flows come from the endowment fund? The benefit will be the students will require less amount of expenses to be borne by themselves because university is giving more funding to them. Okay, I'm just giving an example from the student perspective, current student perspective. So think about this. Endowment fund does not have a fixed, usually does not have a fixed tenure. It is usually kind of a perpetual. So perpetual means what here in case of endowment fund? You can't expect that a student will have a perpetual student life. Current student has a fixed student life. So it's for a student life. But think of the university perspective. There will be another student after this student group. There will be another student group. There will be another student group, and it will continue for a long time. That students will come, and you need to make sure that endowment fund has sufficient balance not to meet up the expenses required by current students, but also the expenses which will be required by the future generation of students. So current generation students may overestimate their importance to get more funding from the endowment fund. But if endowment fund satisfies this objective of the current students, what will happen to the future students? There will be less amount available in endowment fund to support the need of future students. So endowment fund uh, tries to make a balance that I will make a spending or it will make a spending. Typically, it ranges from 2 to 5% annually from the asset under management, asset out of the asset under management or AUM of the endowment fund, so that students' tuition fees, teachers' research expense, not only the current generation teacher and current generation students. So annually 2 to 5% money are to be spent from the asset under management of endowment fund to meet up the tuition expenses uh, of the current student and the future student. And this trend goes on. Okay. So we'll try to talk more about it if we have time later of this today's session. And another thing related to governance structure, but more specific to the investment committee, that is, will you prefer internal investment manager or external investment manager? Okay, so think of a pension fund or foundation or a kind of uh, charity fund, then another endowment foundation, then pension fund, these funds. So you can expect that the board of directors of this fund will not have a very good number of people who have the investment expertise at required level to make the good investment. So usually what they do, they delegate the responsibility of making investment to a third party, like the professional asset management company. Okay. So for example, University of Dhaka has picked a particular asset management company, the name of the asset management company is A. So University of Dhaka has created a endowment fund and has given the responsibility of managing its investment, that means funds investment, to the asset management company, a third party asset management company. So you may immediately recognize that when you are assigning a third party, there will be a fee that you need to pay, a certain percentage of fee. It may be based, a portion of the fee may be based on asset under management and AUM. Another portion of fee may be based on the performance. So these fees will be charged by this asset management company. So it may be like that if the fund size is a very big fund, it is a very big fund, for example, the endowment fund here. The fund may analyze that it is worthwhile to develop an internal investment manager by hiring or recruiting investment expert by ourselves rather than giving this task to a third party or external investment manager. So other than fees, there are other factors which influence. I'm just giving you an example of fee. If based on the analysis of fee structure, you have understood that by having lower expenses, you can get same amount of benefit by employing internal investment manager or by recruiting investment manager by yourself rather than relying on the third party asset management company. So it's not based on only the fee. It is one factor. It may be such that you can't compare uh, the expertise with the asset management company, a professional asset management company, with a group of 5 independent professional investment managers who will be working as internal. Maybe you have been able to reduce the fee by employing these 5 as a internal investment committee or 5 managers in your investment committee, and they are managing your asset in-house. Okay, but matter is that uh, it may be such that the resources other than the investment manager, the resources to be required for effective investment implementation may not be available in internal system. In that case, you need to rely on the asset management company. So it's not only about the uh, investment manager or the fee structure. For example, you may require very expensive, sophisticated software to maximize the portfolio return and minimize the volatility. So the software may be available with this professional asset management company. It may not be convenient or it may not be cost worthy to the endowment fund to have this software by themselves because their cost will become higher. Okay, so you need to balance these factors to decide that whether I will uh, recruit the investment experts myself and give them the task to manage the investment of endowment fund in-house, or I will try to hire the third party asset management company. Okay, so third party asset management company may be such that they are not listening to you properly, or you can't implement your specific objective, or you can't give them, or you can't make sure that your specific choice is getting implemented with the when the task is in the hand of third party asset management company. So there are some factors you need to balance to decide whether I will keep my investment task internally or I will assign it to the external asset management company. So there are debates that which one is better between internal asset management and external asset management. And based on that strategy of different funds, different institutional investors also differ. Okay, but one thing I just like to highlight to give a brief conclusion from this point, that is uh, if you think of the institutional investor like bank, insurance company, this kind of institutional investor, okay, or the investment bank, uh, okay, in that case it is preferred to manage the investment internally rather relying on the third party. So you know very well why internally is preferred, because they themselves have expertise and they themselves have required amount of resources, skills, capabilities to manage investment well. But in case of pension fund, you may think of a government pension fund. Okay, so it is usually managed by the or the authority which oversees this pension fund of government employees, for example, is the Ministry of Finance. Okay, then endowment, then foundation. If your institutional investors are look like this institutional investor type, you can easily understand that it may not be worthwhile to rely on the internal resource to manage the investment. Uh, okay, their internal resource may not be available or may not be cost worthy to do it internally. So they will try to rely, or they will try to assign their investment task to the third party or professional external asset management company. Okay, so I will try to show you that how Harvard University Endowment Fund manage their uh, investment committee. They manage their investment, whether they rely on the internal investment experts, or whether they have hired or they have built their own internal
স্যার একটা কোয়েশ্চেন
investment
ছিল
internal
যদি
investment.
স্যার
Okay, let me finish. Whether they will try to rely on the internal investment resource, or they are relying on the third party. Okay, so what's the question?
স্যার যদি একটা হাইপোথেটিক্যালি অপরচুনিটি কস্টটা বের করা যায় যে ইনস্টিটিউশনাল মানে অ্যাসেট ম্যানেজমেন্ট কোম্পানিকে দিলে ভালো হবে না ইন্টারনালি নিজেরাই ফান্ড ম্যানেজ করলে ভালো হবে ইন্টারনাল ফান্ড ম্যানেজমেন্ট। তো এটা যদি একটা হাইপোথেটিক্যালি মানে কিছু ফিগার আউট করে মানে প্রজেকশন করে যদি একটা অপরচুনিটি কস্ট বের করা যায় দেন ডিসিশন নেওয়া যায় না? সেটা কি বেটার হয় না এই
uh,
এই সকল ম্যাটারগুলো কনসিডার?
yeah, if the opportunity cost can be computed, but there may be some things of which opportunity cost may not be precisely computable. So you need to obviously there are pros and cons with any of this process, either with internal and or external. So board of directors itself analyze these pros and cons with internal option and external option and pick the one that fits rightly with their mission. Got it?
Yes, sir. Yes, sir.
Okay. So next thing that is to be highlighted regarding the institutional investor, that is the principal agent issues. So as you already have uh, got the governance structure of the institutional fund investment, it is to be clear that who may be the principal or who may be the agent in case of principal agent conflict in case of institutional investor. Okay. First of all, if I take example of uh, university endowment, all alumni or all students or the institutions themselves can't participate directly. So they try to employ the board of directors, which will represent the interest of different stakeholders in the investment. Okay. So board of directors also tries to include an investment committee separately to oversee the investment activities. So it may be such that uh, investment committee is, if investment committee is one party and the investment staff within this investment committee, if we consider them as internal agents, they may have conflict with the external asset managers they are taking they are monitoring the activities of external asset managers, but there may be conflict between these two parties. So investment committee needs to have report their activities to the board of directors, and they also oversees that external asset managers are implementing the guidelines policies set by the investment committee. So which is more common, just to give you an example, that external asset managers tries to charge higher fee. So when they charge higher fee for having the for managing the investment assets, it will reduce the available balance for the fund they are managing. So there may be conflict that how much fee investment committee will be agreed to pay to the external asset managers. Okay. So if you think of the hedge fund, for example, we are not giving example of hedge fund in institutional investor, because hedge fund is not a kind of institutional investor. Rather, hedge fund, you can think of, from our perspective, you can think of hedge fund is a kind of product, like mutual fund is a kind of product, and hedge fund is a kind of product. And usually the fund managers, what I already have mentioned in previous slide, that they charges two type of fee. One is based on the asset under management fee. This is known as base fee. And another fee is based on their performance. So say if they have been able to generate 200 million net return, they will charge 20% of that. And base fee is usually like this. For in case of hedge fund, it is known as 220 rule. The thing is like the 220. So it means that the base fee, regardless of the performance, this 2% of the asset under management, this fee will be due to the asset manager, and 20% will be based on the performance. So you can think of a numerical example that how 2% will be computed and how 20% will be computed. If asset under management is, for example, 5 billion, 2% multiplied by 5 billion. And if 20% is based on the performance, if it is such that this external asset manager has generated 0.1 billion profit in this year, in a particular year, they can charge 20% of 0.1 billion as a performance fee. So the thing is that, which is very common across the world, asset managers always try to make sure that their compensation does not have very close relation with their performance, so that they will have a good they will have a good compensation when the performance is not good. So they try to protect their downside. So for that reason, it is likely that they try to increase this base fee from 2% to say 3%. So think of the consequence of increasing this 2% from 2% to 3%. It is based on the asset under management. So you can immediately recognize that asset under management is a big figure. So any very insignificant change in this base fee percentage will have a big consequence on the actual amount of fee. So they try to negotiate with the investment committee to have a higher percentage of this and to also have a higher percentage of this performance fee. So investment committee needs to balance their objective set by the board of directors and the constraint that set by the board of directors, that how much you can pay for the asset management. They need to balance with this and the expectation of the asset manager on the other side. So if the percentage gets higher, you can easily understand what will happen. But in our country, what happens, uh, there is no presence of this. There is no presence. There is no performance fee. If you just, for example, if you think of mutual fund, asset manager does not have any performance fee structure. Rather, they try to make sure that they have a good amount of compensation from the asset under management. So regardless of the performance of asset under management, what will happen? In that case, the motivation of asset manager to do well compared to others will get shrinked. They will not be highly motivated to perform well, and they will not feel very sad like the stakeholder when the performance does not perform well, or the performance is not good of the fund what they are managing. So regulator always try to uh, link more of their asset managers fee with the performance rather than the base fee or base percentage. So, but for several years, regulator is trying to impose more fee based on the percentage and reduce this. But for the disagreement of asset managers association, regulator couldn't implement the performance fee based on the performance. So you may easily think that for this reason, for this conflict, the principal agent issue may arise between the asset manager and the investment committee. Okay, and sometimes it may be like that investment committee is thinking of a asset management company or a particular uh, asset of to invest to a particular investment company, for example, uh, which may not be good, but investment committee is picking that company or that company's product specifically because they will get a commission to refer. If their investment committee refers this product, they will get a commission. So that is not a good practice. Okay. So to manage the principal agent issues, uh, usually there are some strict governance guidelines that uh, how much fees, for example, can be charged by the external asset manager and how much cannot be paid. There will be maximum ceiling. And in investment committee, uh, which is working on behalf of board of directors, needs to balance the expectation of board of directors and also the expectation of the asset management company who are getting engaged with this particular fund. Okay, so these two issues you need to think of very specifically for institutional investor. So other differences we already have highlighted in the session before the previous session, how they differ in case of private and the uh, institutional investor. Okay. So in case of IPS of institutional investor, you can expect the common components what you already have been familiar with the private client IPS. So you are familiar with what kind of purpose or what kind of things are to be included in the IPS of institutional client also. So first thing which always comes in the IPS, that is the investment objective. But The thing is that in case of institutional investor, investment objective mostly very closely agrees with the mission they are pursuing. So usually in case of individual investor, you think of some goals they try to achieve, and based on that goal they set their investment objective in case of private client. But in case of institutional investor, they set a specific mission, that why we are forming this foundation, what task it will do. And for example, in case of endowment fund, okay, what do you think? In case of endowment fund mission is to support the university expenses. It is one of their primary goal, and another goal is that they will maintain a specific balance which is protected from the changing inflation. Why they are maintaining this balance? For the future generation, or the future students, or the future research community who will get engaged in the university endowment. Okay, and you can immediately recognize who will be the stakeholder of this university endowment fund, and who what purpose or what objective will be set by the endowment fund. But in case of foundation, for example, you probably have heard about the Bill and Melinda Gates Foundation. You probably have heard about the Sir Fazlur Hassan Abid Foundation, and you also have heard about the Obama Foundation. So just to give you an example, Bill and Melinda Gates have a specific mission. They try to spend or support the educational expenses in USA, and outside of the USA, Bill and Melinda Gates Foundation works for the health and the poverty. So their mission, from their mission, you can immediately recognize that what will be their investment objective, what kind of goal they try to achieve. So these things will be mentioned in the very beginning of the IPS of the foundation or university or any kind of institutional investor. Let's say uh, a sovereign wealth fund. It is kind of fund we introduced in the very beginning of the course, very first class, that is owned by the government of a country. So these are fund specifically constructed for specific purpose and owned by the government. So, for example, in uh, Malaysia and in Abu Dhabi, there are sovereign wealth fund. So in Malaysia, their investment objective, uh, or first of all, their mission of sovereign wealth fund is to support the development expenditure of the government. And in this case, their purpose is not to uh, support the development expenditure. Rather, their purpose is to convert the non-financial resources. You can think of Middle East is popular, or Middle East is rich with the petroleum resources. So these petroleum resources are non-financial resources. So these non-financial resources are converted into financial resources, and they have been included in the sovereign wealth fund of Abu Dhabi, this fund has been constructed in for the purpose to meet up the future generations expenditure which will be required by the future generation will be maintained by this sovereign wealth fund. Okay, so I think you have got an idea that what kind of objective and mission uh, investment objective are mentioned or included in the IPS of some institutional investors. Okay, so we already have mentioned about the governance structure. You can think of IPS will mention that how this governance structure will be implemented for this institutional investor. Okay, and we already have mentioned that principal agent conflict arise in case of institutional investor, and IPS mentions that how the principal agent misunderstanding or their confusions will be solved. Okay, and related to this, these two things are very unlikely to be clear in case of individual IPS. So you get some additional point in case of institutional investor IPS. And another thing that is uncommon in case of private client, but similar to the goal set by the individual client. Okay, and another thing that is common with private clients IPS, that is IPS of institutional investors includes or mentions the constraints to be faced by the institutional investor. Okay, it may be such that for example, institutional investors are uh, institutional investor get some tax advantages because, for example, university endowment or foundation by some charitable institution are set up for the holistic purpose, for a very holistic goal to be achieved by this institutional fund. So government always tries to give some tax advantages, some regulatory benefit to this. But matter is that for having this benefit to be realized, there are a good number of constraints to be maintained by this institutional investor. So there need to be very specified in case of IPS. So for example, if it is such that university endowment, uh, 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 just to give an example, if it is such that university endowment, it has been mentioned that university endowment uh, investment return from their investment will not be taxed if they don't if they do not make any investment in uh, say a startup. It is not a real thing, just to give you an idea that how constant may look like. So you can think of a startup is a very high risky initiative or high risky investment in the part of alternative investment. So a particular government can impose restriction that if the university endowment make investment in a startup, I will not give the tax advantage to this endowment fund. Okay, so in that case, what will happen? In that case, university endowment is restricted in that particular country to make investment in startup. And if you think of the bank, you are very familiar, or it is very well known to you that there are numerous restrictions on the bank's investment, that where they can do invest and where they can't make investment. So these constraints may not come from the sponsor or the immediate stakeholder or the most the stakeholder kind of its sponsor institution. Rather, it can come from the environment in which it is operating. It can come from the country in which it is operating, or it can come from the jurisdiction in which it is operating. Okay, so you need to mention the constants there. And rebalancing reviewing policy, how it is to be done will be included in the IPS, and how asset allocation will be made, and how investment guideline for making asset allocation will also be there in case of IPS of institutional investor. That is common in case of also private client IPS of private client. Okay, so let's talk about the specific part of IPS of institutional investor. I already have mentioned some general example of these parts, but more specifically, I already have mentioned the investment objective of institutional investor will directly reflect their overall mission. Okay, so if you think of insurance company, so their insurance company, uh, what they will try to do, they have a shareholders, they will try to maximize the wealth of the shareholders, but making sure that they are meeting their liabilities and the risk associated with the assets and liabilities, and they are meeting the expenses required. So for banks and insurance company, it is likely that they will try to maximize the wealth of their shareholders, or more specifically, the net present value of the these are very common in case of profitable enterprises or profit making enterprises which have been set up to maximize their wealth of the shareholders. But in case of other institutional investors, say endowment, pension fund, then foundation, it is not the kind of to maximize the wealth of the stakeholders, because there will be a conflict. Okay, uh, so for example, in case of pension fund, where we need to spend more time to understand uh, who are the immediate stakeholder of the pension fund. The employees are the immediate, or employees are the most important stakeholder of the pension fund. So pension fund has a very diverse nature uh, based on their conditions. For example, if a pension fund is a kind of frozen, so what does it mean? A pension fund is a frozen. It means that no new employee will be included in this fund. That means already some existing employees' pension benefit have been included in this fund, and no new employee is to be added to this fund coverage. So what will happen for a new employee? For new employee, there will be new pension fund. So it is not like that for uh, million employees, there will be one pension fund, and there will be several pension fund based on the varying criteria. Okay, so think of two frozen pension fund, uh, say Mr. A pension fund and B pension fund. Both are frozen. So in pension fund A and pension fund B, say uh, in pension fund A, more employees are very close to the retirement, more are very close to the retirement. But in case of B pension fund, uh, more employees are far from the retirement. A very less portion of their employees are close to the retirement. So whatever their proportion of their beneficiary here and here, the thing is that their main investment objective is to make sure that they are managing their assets in a way which will meet up their pension liabilities. So, for example, in some countries, you may find that there is higher proportion of aged people. There is a higher proportion of aged people. So you can easily expect that in that country, the pension liability of their pension fund will be a bigger number, because the more people will be receiving the pension benefit. But the sum up of this discussion is that their investment objective is typically to maintain investment in a way so that their pension liabilities can be met well, or meet in a satisfactory way. So one thing which is very common in case of investment objective of pension fund, that is the fund uh, fund ratio or funded status in case of pension fund. So it is very important in case of pension fund to maintain this. So what does it mean? It means that uh, the ratio of pension liabilities to the assets of pension fund. So if this ratio, say, here is the assets of pension fund and the present value of all liabilities of pension holders. So if this ratio is a big number, say it is more than 100, more than 100 means 100%. If it is such that asset of pension fund is 120 and liabilities of pension fund is 100, in that case it is 100%, more than 100%. In that case, it is known as funded or positively funded. So it is good that pension fund has sufficient assets to meet up the liabilities of the pension fund beneficiaries. But if it is such that pension fund is underfunded, like 70, assets and liabilities is 100, so it is a very riskier thing in case of pension fund, because they will not have sufficient assets to meet up the liabilities of pension fund. So based on this, you can easily expect that what will be the investment objective of pension fund. Pension fund will try to achieve a funded ratio at least over 100%, so that it can maintain the liabilities well. Okay. So Khalid was trying to ask something. Khalid, you have
Hello.
raised hand.
Yes, sir.
Yeah.
স্যার এই যে পেনশন ফান্ডের ব্যাপারটা নিয়ে যে প্রতিবার যে নিউ পেনশন ফান্ড খোলা হয়,
Hmm.
যেমন ধরেন এই যে একটা সরকারি অফিসে 100 জন আছে,
Hmm.
তো 100 জনের তো একটা পেনশন ফান্ড থাকে। এখন নতুন আরো 10 জনকে জয়েন করা হলো, এখন এই 10 জনের যে আলাদা একটা পেনশন ফান্ড, নাকি
Eh,
ওটার সাথে অ্যাডজাস্ট করে নিবে
It's
আগেরটার
not.
সাথে?
It is not such like that. In case of pension fund, in government pension fund, the funds are not institution specific. The funds are in aggregate managed by the government. So government institutions pension fund are not managed by the individual government institution. Rather, Ministry of Finance has the authority to manage this. Okay. So there may be varying criteria that it may be based on the time frame that who will be included in this pension fund, what should be their joining date. In that type of criteria, the pension fund are constructed. It's not such that only for 100 employees, one pension fund will be constructed. There will be million and more than 10,000 or more than 50,000. I don't know a specific number, but the structure is like that. Okay. Have you got it?
স্যার আমার একটা কোশ্চেন আছে।
Khalid, have you got it?
Yes, sir. Yes, sir.
Okay. Sagar?
স্যার ফান্ড রেশিও নিয়ে স্যার আমরা যখন বললাম যে ফান্ড রেশিওটা 100% বা 1 এর চেয়ে বেশি হবে তখন ওটাকে স্যার প্রপারলি ফান্ডেড পেনশন ফান্ড বলবো। স্যার এখানে যদি স্যার 1 এর থেকে অনেক বেশি হয়ে যায় বা 100% থেকে অনেক বেশি হয়ে যায় তাহলে স্যার কোম্পানির পার্সপেক্টিভ থেকে আইডল অ্যাসেট অনেক বেশি হয়ে যাবে না? বিকজ যেহেতু অ্যাসেট অনেক বেশি বাট লায়াবিলিটি অনেক কম, তার জন্য স্যার সেই পেনশন ফান্ডের টাকাটা তো কোম্পানি ইউজ করতে পারছে না। তার জন্য স্যার
Don't expect that the asset, what I have mentioned, are the liquid asset here. Investment is also included here.
So তার মানে ওই পেনশন ফান্ডের টাকাটা কোম্পানি অপারেটিং প্রফিট হিসেবে দেখাতে পারবে?
Why operating profit?
সরি, নন অপারেটিং প্রফিট হিসেবে দেখাতে পারবে?
Pension fund has made investment, and investment is also part of these assets. Okay, you have made a point of idle money. There is no idle money. Idle money, you are maybe thinking of some liquid asset. Okay, so there will be a component of this asset which is in liquid, but that is not a big number. Okay, your pension fund investment is also part of the assets what I have mentioned in funded ratio. Okay.
Yes sir,
I'm not saying anything about the financial reporting. I'm not saying anything about the financial reporting of pension fund. You will get several readings for this pension fund financial reporting when you will have a professional education. Okay. Okay. In case of endowment fund, I already have mentioned that what kind of investment objective they try to pursue. Okay. And in case of say your foundation, I also have mentioned, but matter is that investment objective typically includes some return statement, that how much return I try to achieve over medium to long term or in very long term. Okay, but thing is that when they mention that my endowment fund tries to achieve say 10% return in a year, it is usually by taking consideration of inflation changes. So it is not in nominal term, they try to include the long-term inflation which is expected to happen. Okay, so the inflation index, what we usually try to use commonly, the CPI or the wholesale price index, are not commonly used here. Rather, say for endowment, one thing which has raised the global concern across the world, that is the increasing expenditure for university education. So you know very well what may be the reason for increasing expenditure for higher education. So if it is like that, university endowment investment is not growing in a way which meet up the required expenditure to be needed by the university, in that case your endowment may not work well. You need to take help from other sponsor. You need to increase the tuition fees of students. Like this kind of activities you will try to take. So when university endowment set their return objective, they include inflation index or inflation percentage, not based on the CPI, not based on the wholesale price index, but there is a index which is available for them, that is higher education price index. Higher education price index. So you can think of basket which reflects how the higher education expense or higher education expenditure will change from time to time. Okay, so let's talk about the investment parameters. What we something similar mentioned in case of private client, but in case of institutional investor, first thing alike with private client, that is you need to mention the risk tolerance of the institutional investor. How say it is not like that you will uh, ask about a questionnaire. There are other strategies which are used to understand the risk tolerance of institutional investor. You will have a very brief, you will have a very detailed discussion with the board of directors of the institutional fund, and you will have got an idea that how they will express their risk tolerance. Okay, so uh, just to give you an example, that in case of uh, pension fund, two things are important always: assets and liabilities. Okay, so asset will grow or asset may come down for the volatility, and the same thing may arise with the liability. Okay, so you know how to measure the volatility with the help of standard deviation. So in case of pension fund, usually they try to think of the risk in terms of volatility of the return, uh, which is a difference between the return of assets and the difference of the and the return from the liability. So what do we mean by the return on liability? It means the changes in the liability value. Okay, so changes in the liability value. So they try to take a big picture, the overall volatility or the standard deviation of asset return over the volatility of the liability return. But in case of bank and financial institution, you will get a statement in case of their IPS, if you can make it available, that they express their risk tolerance in terms of some statistical measure, one popular measure known as VAR, value at risk. I don't know whether you have learned about or heard about this term earlier, value at risk. Okay. So what does it mean? It means that what is the minimum loss that is expected to happen over expected time period for a certain percentage probability. Say a bank has mentioned that my VAR is that I can my VAR is minus or you can think of in this way 0.5% loss. Just to give you an illustration, 5% loss, my VAR is 5.5% for in a 1 day period with say 5% probability. So if you think of the expected return of the bank portfolio in this position, you will place this here minus 0.5%. So there is a probability of having this minimum loss. So it is the minimum loss. There will be more loss in this region, and there will be return less loss or more return in this region. Okay. So a 1 day period means what? 1 day period means if you think of say uh, in a month, if there are say 20 days, in a month. Why we are taking 20 days instead of 30 days or 31 days for considering the holiday, okay, for excluding the holiday or for just for including the trading days, okay. So of 20%, of 20 days, 5% day means 1 day. So in a particular 1 day period, bank can tolerate how much loss? 0.5% loss in its portfolio. Okay, so you may express this, or bank may express this, what will happen, for what about the 1 month period, for what about the 15 days period, how much loss I can tolerate. So this is the minimum loss that is expressed in terms of VAR. But there are some limitations, like we have expressed the distribution in normal distribution, like then VAR does not say anything about the maximum loss beyond this minimum loss point. So there are some constraints with the VAR calculation, some ambiguities, not ambiguities. That means there are some questions which don't have answer if you ask from the VAR. In that case, some modification of VAR has been made. One modification is known as conditional VAR, which give you some estimation that what may be the maximum loss can happen if you go beyond the left tail, what we just have mentioned. If you go beyond this tail, what will happen, how much loss can happen. So these are uh, some very special topics, just to give an idea that how the institutional investor express their risk tolerance in terms of what and how they explain their risk tolerance. Okay, so say for endowment and foundation, they need to they will try to mention that I will tolerate this percentage, say 2% of volatility of my portfolio return in 1 year, say not more than this. Okay, so uh, so that I can meet up the spending requirement for the and from the endowment for my university, or from the foundation for my institution in which I'm giving the charity. Okay. Then investment parameter, I already have given example when I was discussing the brief points or brief highlights of the IPS. Say the acceptable risk and the acceptable asset classes to be included in the institutional portfolio will be mentioned in the standards, in the constraints part. And you can recall the investment parameters. There will be some legal constraints, some regulatory, some tax constraints, some accounting constraint. And other than this, which is to be discussed more broadly, that is the portfolio asset allocation, how it is to be made for my institutional investor. Okay. First of all, in case of individual or in general portfolio allocation, typically what is to be used, that is mean variance optimization portfolio model is used, so that I include the efficient assets and efficient portfolios in my fund, and I exclude the portfolios which are not efficient, so that I can maximize the return. But if your target is not to maximize return or minimize risk, rather you try to achieve, for example, you try to achieve a 20% return, and you are prepared to tolerate the risk level associated with, say, for 20% return, you have to tolerate 5%. So you are not making constant, you are not giving constant here. Rather, you are expressing in such a way that for having 20% return, I am free to tolerate the volatility associated with 20% return. So in that case, your objective varies. So in that case, your allocation will also vary. Okay. So the allocation for 20% return and the allocation for maximizing return and minimizing return will obviously vary. This will not be same. So you will get some idea when you will learn about the mean variance portfolio optimization formula, then how to give weight to a particular asset class, and how much I need to include. Other than this, there are some general rule of thumb, say 65 in equity, 35 in fixed asset, and out of 65 in equity, how you will allocate the asset, how will allocate the equity in different uh, security to be which will give you the expected return you are expecting. Okay, so other than this, there are some models for asset allocation which have become popular and which are not introduced in the reading before 2020. Before 2020, it has been introduced for 2021 curriculum for CFA education. As you know that it has become very popular nowadays, and this have been included in the uh, to get an idea that how this model of asset allocation work. Okay, so these are different from the these are kind of some comprehensive model that how it is to be followed. Okay, first of all, let me give you some idea that in case of Norway model, it has become popular from the Norway pension fund. So in uh, in developed country, unlike other country, though we are not developed, so it is not comparable, but in developed country it is common that universally they have access to pension. So universally they have access to pension means what? It means that all people, irrespective of their job status and their employer status, they have access to the pension benefit. So they have access to the pension benefit, but in our country, pension is a kind of blessing. Okay, it is not common. I will show you a picture later of this session so that you'll get an idea what is the situation in our country. So in Norway, there is a Norway Global Pension Fund, which is a kind of government pension fund, global. So this model says that we will have, or the particular institutional investor who will follow this Norway model will invest their portfolio in equity and fixed income. So you may immediately ask which will get higher concentration. So the answer is that in Norway model, the higher concentration will be in equity, and remaining concentration 40% will be put in the fixed income securities or fixed income portfolio. Other than these characteristics, so you can get immediate picture that they are relying more on the equity. And another thing you need to immediately recognize, they are relying more on the traditional asset class, equity, fixed income, these things. I have not mentioned anything about the alternative investment. So from the Norway model, you can immediately recognize they have kept no room for making investment in alternative investment like hedge fund, private equity, these things. Okay. So another thing they try to follow, or what they tries to follow Norway model is Norway model Norway model does not rely on the active, rather they tries to rely on the passive. So what is the passive strategy? So you are replicating a market portfolio, or it may not be necessarily market, it may be other non-market portfolio or non-market index, non-market benchmark. So you are particularly replicating index to construct your portfolio. Okay, so they try to make sure that there will be very least difference in the weight of a particular asset in the portfolio they have constructed, and the portfolio, the index has the portfolio index is representing. So index is, for example, giving say 2% weight to a particular security A. So they will try to make sure that their weight to that particular security is not significantly different from 2%. It is very close to this 2%. So there's a term which is important to know, that is the tracking error. I don't know whether you have heard about this term, tracking error. So it measures the difference, that how much deviation you are making from the particular benchmark. So if you are making a very high deviation from the benchmark you are following, in that case, your tracking error is high, and the vice versa. So as you have got the structure of Norway model, you may ask what will be the benefit for the people, or for the institutional investor who will follow this, and what will be the problems for the institutional investors who will follow this Norway model. So first of all, you may immediately recognize that when you are replicating a passive portfolio, your cost of managing portfolio goes down, because you know very well active management is expensive compared to passive management. You are relying on the available benchmark. Okay. Another thing is that when you are making investment, as you are not constructing a distinctive portfolio, that's why you are not recruiting a specialized manager. And now when you are recruiting a specialized manager, if it is such that there is a chance that a poor manager can be selected who does not have the required or good skill. So when you are replicating a passive portfolio, you are relying on the index. You don't like to construct a portfolio by yourself. So the risk associated with choosing a poor manager goes down. But the thing is that apart from these good things, there are some bad things which you need to recognize. That is, when you are replicating a portfolio perfectly with very least tracking error, you will have very low potential to achieve a good alpha. So you know what is the alpha? When you outperform the benchmark, your alpha is positive. Okay. So I'm not telling more about alpha here. I think you will get it more when you will estimate or when you will try to concentrate on the performance reading. But recently it has been found that though it is very unlikely that a good amount of alpha can be achieved, but there are some systematic factors which have been discovered in academic research. I think you have probably come to know about it, that small size stock performs well relative to big size stock. Size factor, then value factor, then momentum factor. These factors are known as some kind of systematic factors. So recently, Norway model, it has been found that managers are trying to achieve higher return by capitalizing on these systematic factors. So what does it mean? They are trying to, as a small size stock gives higher return, they are buying a small size stock and selling a big size stock. So they are getting return from the difference. Okay. And now endowment model, the second one. But immediately you need to understand that the things are very opposite to what we have understood in Norway model. So let's talk about the endowment model. In Norway model, we have not put any room, or we have not given any room for alternative investment. But in endowment model, it gives more space to the alternative investment. So you can recognize that if a particular institutional fund is following endowment model, that is taking more risk compared to Norway model. Okay. And another thing you can contrast with the Norway model, that is they try to endowment model, they try to follow the active investment strategy. They don't replicate any index blindly. They try to construct their portfolio themselves. Okay. But matter is that from the endowment, you may feel that this model is particularly applicable for endowment, but the thing is not like that. Though this model has been introduced by the Yale University, but it is followed by some other institutional fund also who have the investment objective similar to set by the strategy, asset allocation strategy uh, suggested in endowment model. Okay. But in some cases, you need to recognize that when you are making active construction or active portfolio management, you need to be very you need to have a good amount of resources. You need to have a very high amount of expertise. So for a small endowment model, for example, a very small university, it may not be replicable. It may not be implementable. Why? Because the cost of active management uh, may not be affordable for that small university. Okay. Then Canada model, you need to we need to understand that Canada model is has some characteristics similar to endowment model, but we need to make a distinction, that is in endowment model, one thing is they rely more on internally managed assets. Can we recall internal management and external management we have uh, mentioned in the very beginning?
Yes, sir. Internal management হচ্ছে স্যার
Okay.
যখন
Okay. What I mentioned, which is suitable for endowment foundation, external management or internal management? Which is more suitable or more feasible for the endowment and
Or maybe
foundation?
external managed.
Yeah. So it is more suitable for them, externally managed asset. But in case of Canada model, they concentrate more on internally managed asset, and other things are very similar to the endowment model, what we just have mentioned. One thing that is to be distinctive with the endowment model, and other things with the Canada model we need to recognize is that they follow some reference portfolio, and they have some aggregate portfolio approach. So let me give you some brief idea that what we do mean by the reference portfolio. And one thing you already have got it, that active management is present in Canada model. So reference model is such that though there are some market index or market benchmark available, so the investment committee of institutional investor may feel that I'm not, or we are not understanding the market benchmark very well. Rather, by following this model, we construct a portfolio by ourselves, which will be easy to implement, easy to follow, easy to understand, and will be very less expensive compared to market portfolio. So that will be known as reference portfolio. It is in-house construction. And what is the purpose of this constructing this portfolio, this index? The purpose is that the investment manager who is following the Canada model will take the reference model as a benchmark and report their performance based on this reference portfolio return. But it does not necessarily mean that the actual portfolio of the Canada model will be similar to the reference portfolio. So the actual portfolio may differ from the reference portfolio, but when they will compare the performance, they will replicate, or they will represent that how much better we are performing compared to the reference portfolio. Okay. And another thing what I added, that is the total portfolio approach. So when total portfolio approach you are thinking of, you need to, you can make rebalancing. You can make rebalancing in your portfolio allocation, say from the alternative investment, you are increasing investment in alternative investment, and you are reducing investment from, say, public equity. So you can immediately recognize you are choosing asset class which is more riskier compared to public equity. So that means you are adding more risk to your portfolio for including this one. So when you are doing this, you have to maintain the overall risk of the portfolio constant. So how can you do this? You can increase the proportion of your investment in fixed income. So you know the volatility in fixed income is lower relative to these two. So when you are investing more here in alternative investment by reducing investment in public equity, you need to make a higher position in fixed income in the same time, so that the total portfolio risk does not get disturbed. Total portfolio risk remain as it was. Okay. So let me conclude by telling about some LDI model, that is the liability driven investment model. So what does it mean? It means that rather than concentrating on the asset side of your balance sheet, you will concentrate on the liabilities of liabilities. Okay. That means it does not mean that you will not look at your assets. So it means a total approach. That means you will concentrate on both liabilities and also on the asset. Okay. So say for example pension fund. In case of pension fund, there are pension liabilities and pension fund assets. Okay. So you need to look at how your liability is growing, how your liability is growing. So based on that, you need to make sure that your asset is growing at a higher rate relative to your liability growth, so that you will not incur a problem later when you need to meet the obligation. Okay. So usually in liability driven investing model, there are how it is distinctive. There are usually two type of portfolio maintained to meet up these liabilities. So one type of portfolio is maintained in a way so that the risk associated with the liabilities can be offset. So you can think of a hedging portfolio, and another portfolio is constructed which is known as kind of return generating portfolio. So a hedging portfolio will include less volatile asset, so that it can hedge uh, against the portfolio which is highly risky. And in case of return generating portfolio, your task is not to include the assets which are very safe. Rather, you try to include more of the assets in this portfolio which will give you a higher return, so that you can meet up your investment objective. Okay. So let me conclude today's session just by showing you what is happening in case of pension in Bangladesh. If you are a government job holder, you are in this 7.6% population of 65 plus population. Right now we have 7.9 million. So out of this 65 plus aged population, 7.9 million, only 7.6, 39.9, and 10%. How much it is? Approximately 60%. Approximately 60% have some kind of pension benefit. So you can think of this old age allowance, which is known as Boyoshko Bhata in our country. Okay. So you know that how good the distribution is in our distribution system, though it is a percentage based on the statistics reported by the BBS. So based on that, it has been found that more than 40% people does not have any kind of pension benefit. So in our family, when we see a person has taken retirement after 65 years, family members tries to avoid him. The reason is that he is not a person who is contributing much right now, and he becomes burden. But in developed countries, it is not the thing like that. When Canada pension plan was introduced, in that time, initially their life expectancy was 65 years. Then their life expectancy becomes 75 years after 2 decades. Then now their life expectancy become 85, 84 plus something. Okay. You can expect that defined benefit liabilities obligation goes up when the life expectancy goes up for the employee. Okay. So in developed countries, it is very common that they try to develop a pension plan in a way so that all people who get retired from their job or who get retired from their business, they will have a good flow every year to meet up their lifestyle needs, what they would maintain when they are working or they are in the life before retirement. Okay. So the matter of regret in our country is that right now we have no universal pension plan. So one of the motivations for including in government workforce is to get the pension benefit for this reason. But in developed countries, the situation is not like that. And for our country, if you ask me that how private sector employees get pension, you probably have heard about the provident fund, you probably have heard about the gratuity, and from your tax course you probably have learned about the 2.5 crore gratuity is tax exempted. Can you recall? So this kind of pension benefit, tax advantage or tax benefit is given to the pension fund. You can think of a gratuity fund is also part of pension fund. Okay. So that is all about for today's session. Let me stop the recording, then I can